We begin, though, with our talk of the tape. Your money in the final stretch. What's likely to happen in the last days of this lousy year for the markets? Let's ask Wharton Professor of Finance Jeremy Siegel. He joins us once again here in Overtime. Professor, welcome back. It's great to see you.
Good afternoon, Scott.
Came a long way from those mid-October lows, Professor. Where are we going from here? Do we have room to run into the end of the year, or did today's jobs report derail that?
No, I don't think so. And by the way, I did not regard today's jobs report as hot. I mean, first of all, the household data was negative, minus 150,000. And something else that was just mentioned in the last segment, but it's very important. People ignore the hours worked, and that fell. And even though it only fell a tenth of an hour, that's equivalent of over a 200,000 loss of payroll individuals. I mean, what is the input in the economy is not just the number of people, but how many hours they work. So I didn't regard this as, I mean, it wasn't a terrible report, but I didn't regard this as anything on the labor front as being a strong report. Now let's go to the wages.
Let's go to stocks. Let's go to stocks for a minute. Let's go to stocks for a minute, Professor, because we had a pretty nice comeback today, right? We're down 350 at one point after that report came out, and we've come back, right? The Dow closes positive on the day. You've got the S&P 500 above the 200-day moving average. So you think this clears the way for? Well,
I think what happened during the day was people were beginning to say this isn't that hot. And by the way, you know, look we had 5% year over year wage growth. We have 8% inflation. Workers are trying to catch up, and they're not. They're still falling well behind. I mean, you know, it just disturbs me to think that the Fed's policy is to crush wages so they go back down to 2%, are basically saying to the worker, you're not going to catch up to inflation, and we're going to prevent you from catching up to the inflation. That's an insane policy. And by the way, I mean, I've talked to, Bullard about wage inflation. He said, I don't look at that wage inflation when I try to choose or determine what price inflation is. And he's an uber hawk. So, I mean, this idea that, the worker trying to catch up because he's lost so much purchasing power is something that the Fed has to crush, to me, is extraordinarily bad Fed policy. And I don't think it's inflationary, because it's inflationary when wages jump ahead of prices, not when they lag behind prices. And I think what's happened is the market is I think what happened today was beginning to say is, well, when we look at the price, look what happened to ISM prices yesterday. I mean, that was outside of the few months following the pandemic. That was the first decline in 15 years. And all the other price indexes that we've been talking, all of them are, basically going down. So people are saying, despite the wage catch-up, the price action is going to be amenable to the Fed greatly slowing down. I mean, my feeling is it's 50, and, my feeling is that that is going to come in, that they won't even have any next February. But we'll have to see what happens. They're not indicating that now. But if that does happen, wow, that's good for stocks, good for bonds and stocks.
Yeah, you said a few weeks ago that inflation was basically over. That's what you told me.
Yeah, and I still believe it, because I don't think this wage increase is catch up, and I don't think that this wage increase by itself is inflationary. Everything else that I see on the price front, everything else, and I mentioned the ISM, Case-Shiller house index down again, big. House prices turning, rental indexes are turning negative. I mean, it's not only a slowdown in inflation, it's actually negative inflation on many of these important categories is still coming through. And, we've talked about the fact that, the BLS index and the Fed index lags on the housing. It's going to continue to show those housing increases, which, is going to, if the Fed wants an excuse to keep on raising rates, they're going to point to what I consider a faulty index and not an on-the-ground index of what's happening. And more people are, writing me and saying, yeah, I think that that's actually the case. There's more not cognizant. So I am not changing my view that, inflation is basically over. This is catch-up wages, and the Fed should not be setting policy to go against that.